A. Identify and explain the different types of responsibility centers. Cost centers focus solely on cost control. Managers are responsible for controlling expenses but do not directly generate revenue. Examples include manufacturing departments or administrative units. Performance is evaluated by comparing actual costs to budgeted or standard costs. Revenue centers emphasize revenue generation. These units are accountable for sales performance but not for production or major cost control. Sales departments commonly function as revenue centers and are evaluated based on sales volume and revenue growth. Profit and investment centers broaden accountability. Profit centers are responsible for both revenues and costs, measured by contribution margin or operating income. Investment centers additionally manage assets and are evaluated using return measures such as ROI or residual income. B. Recommend appropriate responsibility centers in a business scenario. Alignment with managerial authority is essential. Responsibility centers should reflect the degree of control managers have over revenues, costs, and assets. Assigning profit center status to a manager without pricing authority may create unfair evaluations. Organizational structure influences selection. Decentralized organizations often use profit or investment centers to encourage accountability and entrepreneurial behavior. Centralized firms may rely more heavily on cost centers. Strategic objectives guide recommendation. If asset utilization and capital investment decisions are critical, an investment center structure is appropriate. If operational efficiency is the focus, cost centers may be more suitable. C. Calculate a contribution margin. Contribution margin measures the profitability of sales. It is calculated as sales revenue minus variable costs. The result may be expressed per unit or in total. This measure reflects the amount available to cover fixed costs and generate operating income. Unit contribution margin supports decision-making. It equals selling price per unit minus variable cost per unit. This metric is useful for pricing decisions, product mix analysis, and break-even calculations. Total contribution margin evaluates overall performance. It helps determine whether operations generate sufficient funds to cover fixed costs and achieve profit targets within the relevant range. D. Analyze a contribution margin report and evaluate performance. Contribution margin reports separate variable and fixed costs. This format highlights the profitability of individual segments before allocation of common fixed costs. It emphasizes controllable elements and operational effectiveness. Segment performance evaluation focuses on traceable costs. Managers are assessed based on contribution margin after deducting traceable fixed costs, which are directly attributable to the segment. Decision-making considers incremental effects. A segment with a negative net profit after common cost allocation may still provide positive contribution margin, suggesting it contributes toward covering shared fixed costs and should not automatically be discontinued. E. Identify organizational segments used for evaluation. Product lines are common evaluation segments. Companies often assess profitability by individual product categories to determine resource allocation and pricing strategies. Geographical regions provide performance insight. Evaluating by territory or country helps management assess market effectiveness, distribution efficiency, and regional demand patterns. Other meaningful segments enhance accountability. Customer groups, distribution channels, or service lines may also serve as evaluation units, enabling targeted strategic analysis and performance improvement. F. Explain why allocation of common costs creates performance evaluation issues. Common costs are not directly traceable to segments. Examples include corporate headquarters expenses or shared marketing campaigns. Arbitrary allocation may distort segment profitability. Allocation can create misleading conclusions. A profitable segment may appear unprofitable after common costs are assigned, potentially leading to poor strategic decisions such as discontinuation. Fair evaluation requires careful treatment. Many performance reports exclude common fixed costs when evaluating segment managers to maintain goal congruence and ensure accountability only for controllable elements. G. Identify methods for allocating common costs. Standalone cost allocation assigns costs based on independent usage. Under this method, each segment is allocated common costs proportionally to what it would incur if operating independently. This approach emphasizes fairness but may ignore cost interdependencies among segments. Incremental cost allocation prioritizes ranking of segments. Costs are allocated sequentially, with primary users receiving full allocation of incremental costs, while remaining costs are distributed to other segments. Results depend on the order of allocation. Allocation method selection affects performance evaluation. Because common costs are not directly traceable, different allocation methods can significantly alter reported segment profitability and influence managerial incentives.